Good afternoon. Time to check in on the markets. Well, it was a mixed performance on the Asian side following a week that started with sharp falls. Given the speech that we got from Fed Chair Jerome Powell on Friday that many have described as hawkish. Nonetheless, the Nikkei up 1%, Hang Seng Index in negative territory, closing lower, down 0.4%. And it's that Powell's pushback in tone from what markets had hoped would be a Fed pivot to interest rate cuts that has been one of the most challenging parts for investors to deal with. Nonetheless, when we look at what's happening from a local perspective, we did get results coming out of Harmony Gold. That company reporting a plunge in profit, down 49%, as it battles with rising costs, lower production, as well as impairment losses. Looking at my screen, that share price down 6.4%. We also had earnings coming out of Old Mutual, which CEO Ian Williamson described as the first set of results that don't necessarily relate or are not defined by COVID-19. That share price down 3.5%, even though the company did declare an interim dividend. But to give us some perspective in terms of what is happening on the markets, and also to touch on some of the earnings we've seen so far, we are joined by Charles de Villiers, who's the head of equities at Ashburton Investments. Charles, thank you so much for your time. I mean, given what we're seeing on our screens right now, when you look at our local bourse, how are we holding up, and how would you describe then the global market sentiment?
Thank you very much, and hello to all your viewers. I mean, as you said, we are in a period of the markets at the moment where volatility is the name of the game. Looking at the SA market today, we're down 20 to 30 basis points, or 0.3%. So slightly weaker. I mean, as you touched on earlier with the Harmony results, the commodity shares on average are quite a bit weaker. And then looking across to financials and industrials, we've got a bit more of a mixed picture. Lots of results coming through at the moment. But I think, looking at performance on a day-to-day basis is quite a bit, is in my mind a little bit noisy, should I say. And maybe it's a bit more meaningful to look at performance on a bit more of a longer trajectory. And looking at the JSE All Share year to date, we're sitting at about just under 2% or 1.8% negative or down in rands. And if you compare that to the US market, we're sitting at about down 10.5% in rands. And then also the FTSE All World Index is sitting, down pretty much 11% in rands again. So for SA investors that have been invested in the local market, although we're slightly down year to date, we actually, on a relative basis, performing quite well. And even if you look at our performance relative to other emerging markets, we're also holding up quite well, with only really Brazil doing quite a bit better than South Africa year to date. But just be aware that Brazil is coming off a very weak base in the prior period.
Yeah, as you mentioned, a lot of results coming through from the likes of Stadio, Supergroup, Master Drilling, you name it. But let's hone in on Old Mutual's earnings. What did you make of their numbers?
Yeah, I mean, the share price is down, I think, 3% just before I came into the meeting with you, which implies that the market is obviously not too enamored with the result. But, looking at the result, it actually wasn't a bad result in our opinion. It came out, we had previously had a trading update, so the actual result came out in the middle of this guided range. Profits from operations, I think, came in at about 4.1 billion, which was up just under 90% year on year. So almost double the weak COVID base of the previous year. So as you mentioned, the CEO mentioning this is almost the first period where now COVID's in the rearview mirror. So, the insurers were obviously at the eye of the storm in terms of COVID, with higher mortalities and other claims being elevated during that period. And this set of result is noticeably cleaner. The interim dividend, as you mentioned, up 25% year on year to 25 cents per share. Gross written premiums up 9% to just under 11 billion. And then the important segment for Old Mutual is their mass foundation segment. The risk sales now are pretty much back to the levels we saw in 2019, which is kind of pre-COVID. So that's quite positive. Net client cash flows up 14%. And the loan book, we're seeing credit loss ratios also normalizing. So, that's been relatively decent. Funds under management, unfortunately, down 7% to 1.2 trillion. And that's obviously impacted by market movements. And then maybe one other area that's under a bit of pressure is within personal finance, where they sell some higher margin complex products, and the demand for these complex products has been somewhat weaker, and that's been obviously hurting the group margins in that side of the business. But I mean, I think overall the solvency of the business remains very good. That's up almost 3% to 187%. So that's within their range of 1.7 to 2%. So as I mentioned, I think it's not a bad set of numbers. Market's probably not that enamored, but I mean, this is typically a company that always looks quite a lot cheaper than its peers, but continuously struggles to convince the market that it deserves a better rating.
So going into SA's results season, I mean, what were your expectations, and were those expectations met so far?
Yeah, I think on average, we've been pleasantly surprised by the results that we've seen so far. They've been generally ahead of market expectations. If you look at the banks, those earnings have been ahead. You've seen ROEs improving nicely. The sector as a whole, the balance sheets are very strong. They've paid healthy dividends. Similar to Old Mutual, the credit loss ratios are now also within targeted range. And then one area to maybe keep an eye on with the banks is that you're seeing you're seeing a slight deterioration in some of the higher risk areas, such as vehicle financing and unsecured lending, etc., which is an area to watch for the period ahead. I think the other SA industrials also have been very good. They've come through on average ahead of our estimates. Maybe a theme there to touch on for your listeners is that the companies that are doing well have typically had to invest in working capital to fund the growth, just because of global supply chain issues at the moment. The one area that maybe also just to touch on again is SA mining. That's where you're seeing earnings still very elevated versus long-term normalized levels, but you have seen some of the commodity prices start rolling over, such as copper, nickel, and zinc, while those linked to energy remain very elevated, like thermal coal, which is impacting, and oil, which is impacting, like the Sasols and the Tungelas of the world. So those are still very, very elevated.
Yeah, let's take things stateside. When you look at how U.S. earnings could evolve in the second half of the year, what's your base case?
Yeah, I mean, I think we've looking in the first half of the year saw quite solid earnings across the board on average, should I say. And I think looking forward, what we are going to be likely be seeing is that they're going to see a more muted future set of earnings. We're seeing inflation starting to bite, coming through a lot of the companies' income statements. You've also got the effect of rates and that impact of higher rates on consumers' disposable income. And so what we think we're going to start seeing into the second half of the year is more earnings misses from companies. You're already seeing some of the US companies start to proactively start laying off some of their staff in anticipation of what they see to be a weaker future economy.
Charles, let's leave it there. Thank you so much for your time. That is Charles de Villiers, who is the head of equities at Ashburton Investments, giving us his perspective on the market and, of course, unpacking Old Mutual's earnings for us. We're going to take a quick break. When we come back, we'll have that CEO interview with the CEO of Brimstone. We'll be talking about their earnings after this, so stay tuned. Welcome back. Brimstone, the BE investment company founded in the mid-1990s, reported their earnings today with intrinsic net asset value down 18.4%, ordinary shares trading at a discount of 34.3%. But to give us perspective and a little bit more color on the period that was, we are joined by CEO Mustek Bray. Mustek, thank you so much for your time. Certainly a very challenging period, especially when you look at your subsidiaries and investee companies, given the fact that they're dealing with higher input costs, etc. But how would you characterize the period that was for Brimstone?
Well, thanks very much. It's been a very, very tough period. The world economy is in turmoil at the moment. It's completely unheard of where the European inflation is higher than South African inflation. Input costs have gone crazy. If I just look at the fuel costs, the cost of coal as well, for the boilers which we use at our factories and that type of thing. The transport and logistics cost has gone crazy as well. So it's been a very, very tough period, for the first 6 months. And in that as well, there were some TAC reductions and quota reductions as well in sea harvest. So it's been a tough period, but we're very happy to still be producing a positive result.
Mustek, how robust a balance sheet are we looking at right now, and what are you focusing on at this particular stage when you look at the balance sheet?
When I look at the balance sheet, I look at our debt as well. Our debt is about just over 2.1 billion at the moment. Our assets at the balance sheet date was about 4.8 billion rand. So we still got enough headroom on that. There's no issues on that. But it's a very tough period that we're going to go through, especially with the interest rate cycle at the moment is an upward cycle. So we're very wary of that. We're very careful about that. And we'd like to, in actual fact, further reduce our debt as we go forward. But, you know, we've got to keep our businesses going, and we're very happy that the business are still producing positive results. And traditionally, especially with our fishing assets, the second half of the year has generally been better than the first half of the year because of the fishing seasons that the companies go out and fish.
On that note then, given this environment that you've just described, does it make it even more difficult to find opportunities that could be outside the broader fishing and food categories?
Well, there are opportunities at the moment, but one of the issues we've got at the moment is valuations. You know, placing valuations, you know, every business we look at, the question is, what is the normalized earnings? You know, we've come through a period of about 30 or 33 months now of COVID. So everybody wants to do adjustments to the numbers they show you. And we don't know what the new norm is going to be. Yes, some of those expenses were exceptional and unseasonal with COVID. None of us had previously lived through a pandemic like that. However, where do we set the new bar and say, look, this is a normalized earnings of a business, so that we can place a fair valuation on the business and you can do a transaction based on what we would see as being the norm going forward. So, you know, expectations are still a bit high, and we need to moderate that once we know what actual costs are permanent now that in the new world after COVID, and what expenses we can in actual fact reverse out of the numbers to get to a sustainable income number going forward, so that we can place fair valuation on the businesses we're looking at acquiring.
Earnings aside for a moment, I mean, if you had to take a broad view of the space that you're in, what would you say is the overall sentiment of empowerment companies, at least over the past couple of years? Because some have described it as slightly clouded.
It's been very, very tough. It's been very, very tough in that, you know, we are forced to keep our black ownership above certain levels in terms of the fact that we offered BEE deals. And as such, we honor those type of things. So it does place a restriction on our ability to raise further capital in the market as well. So it's been a tough period, but once we've signed an agreement, we have to honor the agreement. And we work quite hard at doing that. If I take, for example, our Stadio agreement, you know, expires in another 2 years and 4 months' time. But until that time, we got the shares and we got to honor what we agreed to when we did the agreement 4 or 5 years ago. And it does place undue restrictions on a lot of the BE players. I mean, a lot of the traditional businesses want BE partners. They all want you in, you go in there. But when you try and get out of the transaction, it's not so easy. They want to force you to sell to another BE player. And with the restricted amount of capital available to BE players, it's not always the easiest thing to be able to do. And that is a problem.
Before I let you go, Mustek, what will you and the team be focusing on?
One of the big things we're trying to do is, look, we big time in the food game, and we know that food security for the world is a big issue. We employ, in our 2 fishing companies, we employ almost 10,000 people, and therefore we're supporting 50,000 people at a household level. And we want to make sure that we can try and keep on producing our goods with the least amounts of price increases that we can over the next few months as we go forward, as we know world inflation is around. But we need to make sure that we can put affordable food on the tables of human beings. That's one of our primary objectives.
Mustek, thank you so much for making time to talk to us this afternoon. That is the CEO of Brimstone, Mustek Bray, giving us some color on the period that was, and also highlighting some of the key focus areas when it comes to that particular company. That is it from me. We're going to take a break. When we come back, we'll have more news for you. Goodbye.